Χαίρετε και πάλι. Καλώς ήρθατε στο επόμενο panel. Welcome, ladies and gentlemen. I was asked whether it will be in Greek or in English. I don't know. I guess everyone is... feel free to express yourself. It's an international forum, so maybe Mr. Begg will go in English, although we are in Greece and I have a feeling about the language. However, anyway, I have with me Mr. Gikas Hardouvelis. He's the chairman of the board of the National Bank of Greece. And next to him is Ms. Charlotte Ruhe, managing director of Central and South Eastern Europe of EBRD. Then is Mr. Zanias, the chairman of the board of Eurobank. And at the end, Mr. Begg, a professional researcher fellow of London School of Economics. Obviously, I guess when the organizers set up this panel, they were not thinking that this will happen to the world. So today is the first day of those tariffs that yesterday ended up being for China at the top of 104%. So I will ask first of all of Mr. Hardouvelis. We all know him. We, especially finance journalists, we know his sense of humor and his good way of transmitting things. You have a presentation. You have a few things that will be the basis of this discussion. Please go on. Decide the language. Feel free to do it.
Thank you, Mr. Davlos. I'll try to be brief, and I'll start with, I guess, the question as to why is happening. What's in the mind of Donald Trump for doing this? And he has already claimed that he wants to rewire the global trading system. He wants to, for sure, bring higher paid manufacturing jobs back to the US. That's what his voters want him to do. He wants to make allies like Greeks and the Europeans pay for the security umbrella that the US is providing over the last 50, 60 years, who he considers as free riders. Perhaps we are free riders on defense. And domestically, he keeps claiming that he is going to use the tariff proceeds for domestic initiatives. The tariffs, by the way, for the American citizens is like equivalent to a 4% increase in taxation. It's a huge amount. So why is he doing this? This is something that essentially destroying the soft capital that the US has accumulated over the years. He's destroying the architecture of the global trading system that the US was a founding member and was promoting it. And why is he doing it? It's a question, I always had this question because there's no benefit. I mean, for an economist, it destroys economic rules. I discovered, and I urge you to find it, there's an essay by Stephen Miran, the chairman of the Council of Economic Advisors, who right after the elections in November, he wrote that he thinks that essentially the US is losing in this global trading system. They're providing more than they're getting. And the dollar is way overvalued. They ought to decrease the value of the dollar. He's hoping for he called it a Mar-a-Lago accord, similar to the Plaza Accord. Some of us, I remember it, I'm old enough to remember this back in the early 80s, to bring the dollar down. And he will use tariffs as a tool to achieve it. He will raise tariffs in the beginning and then come to each country and say, okay, you are with me, we'll do a deal, we'll sign a deal, I'll reduce for you, you're a good guy, you push me, you will reduce the dollar. So it seems like what's going on in the last 10 days is like a reflection of what the essay was a month ago. Now, I have some slides to give you a sense of history. Here is a graph that it's all over the media. I'm sure you've seen it in the last few days. The average tariff rate on US imports. And you realize that a 20% increase, and this is the minimum that's happening now, it takes us back essentially to the 1930s. Tariff rates were much bigger before, but it takes us back to the 1930s. And But the change is not, I mean, we should not make the mistake of comparing today with the Great Depression of the 1930s. The Great Depression happened for many other reasons and happened after the recession started, the tariffs. The change today is 3 times bigger than the change that occurred with the Smoot-Hawley Tariff Act, and in an economy which is 3 times more open. Okay, so essentially you have 9 times the shock, so to speak, comparing to the early 30s. Now a lot of discussion in the media is about a sort of an accounting exercise that people do. Okay, if you raise the tariff rates this much, this is how much consumption will decline, et cetera, et cetera. They all talk about the demand side effect and also on the inflation side. There is another element that apparently could be a lot bigger, which is the uncertainty that the new policy by Donald Trump, which is a strange policy and nobody can understand, is generating. And here's a graph of, that some Italian economists have done it, they followed. It starts in 1960, it's done every month. There wasn't much uncertainty about trade policy for many, many decades. And all of a sudden, in the previous Trump administration and the new Trump administration, it's going up. So this, the reason I bring it up is it will have an effect. And I'll show you something. JP Morgan recently used the IMF model to see what a 20% increase in tariffs may do to the growth in the various economies. And they say, well, the United States will also be affected because we assume retaliation. We assume that if the US imposes a tariff on another country, the other country will respond with an equal amount. Okay. The US will be affected most, by 2%. Euro area, 1.5%. China, a little bit less, et cetera, et cetera. What's interesting in this graph, if you can see it, is that the largest effect is the orange bar, especially for the euro area. We in Europe are going to be affected by the uncertainty and the destruction of the environment we operate, not so much by the accounting and the fact that the cost of some goods have risen, et cetera, et cetera. We may be flexible and avoid it, but the uncertainty is doing a bigger damage. So that's interesting to point out. In Greece, by the way, the minister talked about it earlier. I don't want to repeat him. The effects we don't expect them to be very large. We're a much more closed economy than the euro area vis-a-vis the US. Only 1% of GDP is our exports to the US. But we're maybe hit on a second wave. If the euro area is affected negatively, we will be affected as well. Most of the discussion during the last few days is on real GDP effect, on the effect on the real economy, not so much on inflation. And I think the market is right not to concentrate so much on inflation. Here I have a graph of the expectations of inflation over the last year, and you see that in the last year nothing has happened in people's minds about what expected inflation is. The only change happened in the US and China. In the US, we see inflation expectations going up, and in China, we have a deflation problem, and it became bigger after the Trump election. I will simply come and show you some graphs of how the markets responded since last Tuesday, a week from today, or 8 days from today, we had the announcement. These graphs start with 0 on Monday. On April 1st. April 2, we had the announcements. You see the stock markets. I have here the European stock market, American, and the Greek stock market. They have fall about 15 or 10%. So the stock markets were hit a lot because they worry about the economy.
And they continue today. There was a stop, and they continue today.
Okay. The bond market, on the other hand, I have the change in the yield here, government 10-year yield for 3 countries again. US, Germany, and Greece. There is some up and down in basis points. Nothing much has changed. And the reason for that is that there are two forces behind the bonds. One is the real effect, the real economy is coming down, that's pushing yields down. Inflation is expected up, it's pushing yields up. So it's like they do wash out. And when it comes to currencies, because something that Trump obviously is worried about, you see that the Swiss franc, I have it there, the yen and the euro have appreciated, but the Chinese yuan has depreciated vis-a-vis the dollar. The Chinese want to make sure they control it more. They want to make sure they go down. Anyway, from the markets, the market, you can get a sense as to what the fear is the stock market. So today, the open questions are, I don't want to take time, are the markets, have they overreacted or they're too relaxed? Do we expect more depth on the stock market, or you're going to see a recovery? And then the other questions we should discuss is globalization in retreat, obviously in the short run. Hopefully, the Trump policy can change in the midterm elections, and that's in 2027, I guess, November. It's going to take some time. Are we witnessing the beginning of, should we worry? Is the drop in real GDP I showed you, 1%, 2%, is it that big? Is it comparable to the Great Depression? Now, the Greeks here understand this is nothing. I mean, we went through a 25% decline, okay? This is nothing. I don't think this is a repetition of the Great Depression. In fact, I do hope that policymakers have learned economics over the last 70 years. They know how to respond, and they will respond properly. So hopefully the Trump team is an isolated team in the world. And they behave differently. Will the U.S. recover to its previous global hegemony? I think my answer is probably no. I think this is the biggest, what Trump is doing is a big damage to the U.S., to the way the world perceives the U.S. And it's losing its soft capital, its soft power. And what about us in Europe? In the previous panel, the people discussed the solution. The solution for us is, of course, not to respond, not to retaliate, but look inside our union and try to make the union really work. And look at the Draghi report and at the Letta report and make sure the common market does work and the obstacles disappear. So this is the way to go.
So I will keep from this concerning the Greeks, since we are in the mountains, that the mountains know about snow. It's a Greek saying that we know about snow, so we are okay about the things that are coming. However, and I'm going to Charlotte Ruhe here, is globalization over? Mr. Hardouvelis said that maybe in short term, but is it?
I don't think globalization can just end just like this. And so I don't think it's over. I do think it's in retreat from its height. And you see the interest in Europe in being more self-sufficient on many fronts as one of those expressions. I mean, I think Trump takes things to an extreme. And you can look at the failed policy of Liz Truss, who lasted for a very short time in the UK as Prime Minister, coming out with a shocking policy that was basically rejected by her own Office of Budget Responsibility that didn't have a chance.
The 40 days Prime Minister.
Yes, the 40 days.
Yes.
But
lettuce.
you might want to comment on that later. But
The lettuce lasted longer.
So I do, but my point is that globalization is definitely, I think, has passed its peak. And I think that there are some good reasons for that. And there's a lot of work that needs to be done in Europe, but also in the US, to strengthen parts of society that were left behind as a result of globalization. That's where a lot of this anger comes from, that fueled this movement, this MAGA movement. That being said,
I'm afraid, keep your thought, I'm afraid that this is what Greece has as a problem. I mean, we have a booming economy, and this does not manage to go down to the wages of the everyday Greek. Maybe this is something that you're saying about this anger.
Well, exactly. I mean, I should have said at the beginning. So I cover 18 countries of Central and Southeastern Europe for the European Bank for Reconstruction and Development. And we invest a lot of money in helping companies to reskill their workforce, in trying to help parts of the countries that are underserved by infrastructure, trying to strengthen the connectivity of region, particularly Southeastern Europe. And we start to see a lot more interest in better connectivity to the neighbors in the Western Balkans, Bulgaria, Romania, and Greece, wanting to work together to have better regional connectivity, whether for energy, for infrastructure. And I think that this all helps with that particular problem. But maybe I should pause for a minute and let someone else come in.
I will go to Mr. Zanias, and my question is, how about stagflation? Do we think it's coming? Is it coming for the US, or is it coming for Europe? Is it coming for Greece?
Thank you. Stagflation, it depends. This is always the answer of the economist.
I think it's the answer of a Greek most of the time.
It depends. In the US, there will be stagflation because inflation will rise. That depends, of course, on whether the dollar appreciates or depreciates. Also, that depends also on retaliation measures taken by other countries, etc. So the whole story has not developed yet. If you want a yes or no, the answer is yes for the United States. If Europe avoids retaliation, then the probability is smaller, much smaller, of having stagflation in Europe also, which means that I would personally suggest not to retaliate, but try to fix Europe, as a matter of fact, as I think Gikas said earlier. Now, this whole thing, Gikas started saying, why is he doing it? Other questions is, can he succeed? At what cost? And all that. All these are very relevant, really, with whether we have stagflation or whatever. There are many reasons. Gikas mentioned a couple of them. I was reading in an article in the Financial Times that even when he was 40 years old, a real estate developer, he was writing articles in favor of tariffs. So it's a story of 60 years really that has been going on. Now, apart from Iran, that Gikas mentioned, his advisor who said, we're selling you services. We give you a reserve currency, and we give you also defense services. You have to pay something for that. And they are using the tariffs in order to negotiate some better deal for them. There are other reasons. Another advisor of President Trump, Navarro, the trade advisor, blames WTO. He says that the WTO, with the way it works, it adds up with the US having lower tariffs than other countries. The dispute resolution process does not work well. And in addition to that, many countries where we want to export, they have non-tariff barriers, like we don't import beef full of hormones, for example, from the US. So this is the third reason, really. In fact, I was thinking also of maybe a fourth one. The thing is that China is the champion of globalization. So maybe by destroying globalization, maybe it's the only way to contain China. But China has a lot of weapons in its hands. Now, before coming in today, I looked at the markets. I saw a sell-off of US treasuries. So I bet China is involved in that because they hold huge amounts of US treasuries. So they have the power really to press Mr. Trump and inflict pain on the US also, which will be inflicted in any case, really. And they're going to lose their alliances and all that. The thing is that the main problem of the US is that they're saving less. The champions of savings is Europe and China. So they have an imbalance in their account. Maybe the economists understand that because there is a big discrepancy between saving. In fact, the current account deficit is the difference between savings and investment. And people invest more in the US because it's more rewarding, because they have a capital market full of liquidity there. On the other hand, the Americans like to spend money rather than save money. So their problem may be inside the country also. And now they have a debt of 120-something%, a deficit of 6%. If they reduce the deficit, the current account will close also. So this is the thing, that savings from Europe and China go to the US and they invest there and they create all these things. This is the main reason. Really, I don't know how far it can take it, but the rest of the world has weapons to use. We'll see, this story is developing.
I think Mr. Begg has one of the weapons maybe in his mind right now, and it has to do with supply chains.
I'll come on to that if I may.
You come on to that. You have something else you want to at the beginning. Okay.
Nee. Kalispera, everybody. I was told I should speak Greek, but allow me first to be French and act like a French graduate of the École nationale d'administration by saying j'ai 3 points, I have 3 points. And my first 3 points are, look at where the US was 40 years ago. It had about 25% of global GDP. Europe had something similar. China was nowhere. Look at the US share of global GDP today, 25%. So first, what is the problem that Trump is trying to address? He has not been screwed by Europe, as he famously said. Europe has gone down, China's gone up. This wasn't supposed to be up yet.
Maybe they heard the supply chains, which was the cue.
Yeah, this is supposed to come from me. Anyway,
Yes.
Since it's here, this is an interesting chart that I found in a document from, oh, it's gone again. Wait, please. All right, it comes back when I say wait. So now I'll talk about it. What you see here is something that I picked out from a recent publication by the German Marshall Fund of the US. And as you can see very clearly here, what does a Boeing 787 consist of? It has Korean wingtips. It has Italian horizontal stabilizers. It has a Boeing fuselage from the US, but another bit of the body comes from Canada. It has trailing edges from Kawasaki in Japan. In other words, the Boeing is from multiple countries. And if tariffs go on all these things, guess what? It becomes more expensive, Boeing sells less. So we can suppress this now. So I come back to my second point. And here I'm going to switch into Latin, ceteris paribus. Other things being equal, a famous phrase you learn by every economist when they're doing their education. Economists for 200 years have shown that there are gains from trade, ceteris paribus, other things being equal. The US administration, and particularly the new resident of 1600 Pennsylvania Avenue, takes the view that trade is a zero-sum game. Now, who's right? All the economists in this room, or a couple of people in the White House? I think we can take it as clear that there are still gains from trade, and you may lose them. The third thing is just to elaborate slightly on what Gikas said earlier, the rationale that Trump has for his tariffs. Yes, it's about trying to reduce trade deficits vis-a-vis certain countries and to repatriate economic activity to the US. Second, it's about trying to generate income for the US Treasury Department to enable him to maintain the big tax cut from his first administration. But third, he wants to use it to coerce other countries. Look at what happened with Mexico and with Canada. Tariffs unless you stop migrants. And that takes me on to one last point, in addition to my three, and that is there is more to globalization than trade in goods. There's trade in services. There's international financial investments, an international financial system. There is flows of technology. There are flows of labor, a very important part. So all these things are still part of globalization that will continue to be significant. And last, let me just mention, this time going back to Greek, autarky. I'm sure you know the word in Greek, autarkis is ancient Greek. Let's, as an experiment, imagine that the US becomes a completely closed economy, a bit like North Korea. It can look after itself. It has its own energy supply, it can feed itself, it can manufacture for itself. Suppose it cuts itself off completely from the rest of the world. Do we really care?
15% of global imports.
Do we?
That's my rhetorical question too.
Yes. Well, I cannot answer. I think we do.
Yes.
Obviously, we do. Anyway, I could ask, though, and also another question, Mr. Hardouvelis. He said, Mr. Begg said about who's right, the two people in the White House. They created a formula about these tariffs. So, is this formula completely nonsense?
Yes.
I have a feeling that it is.
It is complete nonsense. We can move on from it.
Okay.
Well, it has some rationale from their perspective, which is if you have a surplus, if you are a foreign country, you have a surplus for the US, then they will penalize you.
Yes,
And
but
then-
this is
and
not
then
tariffs in order to have reciprocal tariffs.
They deflated by the amount of the imports somehow, and anyway, it's their game. I mean, they didn't apply it to Europe. They gave a 20% to all Europeans, whether you had 14% or whatever.
And why not Russia?
With Russia, I guess they don't trade, do they?
We hope not.
We have.
I would ask Ms. Ruhe. Okay, so I could understand tariffs, let's say, in wine in the States, because in this way you can boost the sales of the California wines against the French wines. However, does this make any sense for olives, let's say, which you do not have? Does it make any sense for, let's say, as Mr. Begg showed, for cars? You may protect your cars, however, the cars that you're making, they're not made totally in the US. And then, if you start making all things in the US, will it be, at the end, more expensive because of the wages that you're paying against Chinese wages or Vietnamese wages?
Well, we don't grow bananas in America, and so a lot of people are going to be very sorry to see the price of things that they take as staples that they want to buy every day, costing 100% more in some cases. So no, I think that the tariffs are incredibly regressive as well, because they will really hit the low-income parts of society much worse than people for whom the cost of food is just a fraction, a very small fraction of their overall expenditures. But they've pretty much taken a position of completely disregarding the supply chains. As Professor Begg pointed out with the Boeing example, all of the automotive manufacturers have very complex supply chains, very closely integrated with Mexico and Canada, but also with companies in Europe. And so the cost of buying a car in America is going to be much, much higher. And I think I see it as a negotiating tactic. I do think that they've been a bit taken aback by the market shocks and what's happening this week now with treasuries. It's clearly making some people on Pennsylvania Avenue, perhaps at 1,500 in the Treasury instead of 1,600 in the White House anxious. So hopefully what appears to be very aggressive permanent moves could end up being walked back in coming months. I hope so, as somebody with a 401k and a lot of other people with equity investments in the country.
I was listening the day before yesterday. I'll ask it to you, Mr. Zanias. However, about an example. There was the president of the olive makers in Greece saying that there are already containers going to the US, but when they reach the US, the importer will have to pay 20% tax in order to take this amount of olives. And I'm thinking that most probably he will put that at the final price, because otherwise he will lose this amount of money. However, in the next order, he will call the Greek exporter. He will say, okay, I need a reduction in order to have half and half maybe, or because I didn't manage to sell those olives. Is this a scenario that is exact that I'm thinking?
Now, who is going to bear the cost of the tariffs? Depends.
The Americans think that the Chinese will pay the tariffs. Or Trump convinced them that the Chinese will pay the tariffs.
Because it depends on what the economists call elasticities of demand. For example, even in the US, they like the Greek olives, Kalamata olives or whatever. They may be willing to pay the extra cost of the tariff.
Or they will live even without.
If there is a close substitute or something like that, then they say, okay, forget about this, we'll go to Tunisia olives or whatever. So that depends on this. Also, it depends, as I said earlier, on what happens to the exchange rates, the dollar with the EU exchange rate. Now, the dollar now is everybody would expect to be strengthened. It's not strengthened, it's slightly weaker there. And that, in fact, increases the impact of the tariff, in fact. Now, why is the dollar weakening? Because this is very important. I was listening yesterday to Larry Summers, the former finance minister of the US and professor at Harvard. He attributed this to what he says that he said that America at this moment is like an emerging market, you know, weak institutions and all that. So we do that. I would attribute it to other reasons also, plus that probably one reason could be that you know, traders are discounting that there will be the retaliation, for example, so they're waiting. Or the other thing is that you know, it's maybe the status as a reserve currency is at risk of the dollar. So for all these reasons, we may end up with a weaker, as a matter of fact, dollar, which may increase the impact of the tariffs. Now, the thing is, again, Summers, I don't know if anybody else listened to him. I got into discussion there yesterday. He said that somewhere there must be a bargain chip, he said, with all this that's happening. It's a war now. You see what's happening to the American Treasury bills and all that. He believes, and I'm quoting him because I think he knows better than everybody else probably in this room, that we may end up with a much smaller tariff, around 10% or something like this. But this is too early stages, and we don't know, you know, Mr. Trump is probably the most stubborn person in the world. So let's see, wait and see. I'm not sure we can say more at the moment.
Mr. Begg, was the European Union right not to retaliate immediately as China did?
Yes, within reason, because at some point they are going to have to consider a more robust retaliation if it means that European producers lose, and European producers will insist on it. And this, to me, raises a number of things that we need to consider under the heading of what I'd call secondary effects of this transformation of trade. Yorgo has already mentioned the effect on currencies, where maybe the dollar goes down, maybe it doesn't. We don't know over a short or a medium term. But there will certainly be reorientation of trade. And that reorientation of trade is something we need to take into account, because if China is blocked with 100% tariffs from the US market, China will then try to sell elsewhere. And elsewhere will include Europe. It will want to export more to Europe. And in turn, European companies and countries will want to export more to China and more open economy. So retaliation may be one part of the story, but there's another part is what you do in the second stage of this. This will in turn mean a change in many supply networks. You saw the Boeing one, but Americans are now going to have to pay hugely more for their iPhones if they want to continue to buy them, because they're made in China. Whether they get exempted later, we don't know. But there's one last thing I think we ought to take into account in the political dimension of this, and that is that Trump has been using executive orders. You've seen him signing them. He has the handwriting of a 4-year-old. He signs these things.
And the thick Sharpie.
And executive orders are overriding Congress. In the US system, Congress is the authority for trade deals. At some point, the Republican side of the aisle is going to find some of its backbone and say, wait a minute, this is for us to do, especially in any states which are going to be particularly penalized on the Republican side. So let's say there is a new imposition on American whiskey being sent to Europe. Kentucky and Tennessee won't like it. They're Republican states. Their representatives will start to agitate on it. So let's look at the political process as well as the economic, because Trump is on very thin ice with his executive orders. I'm glad to see Charlotte's nodding with me on
Yes,
that.
she's nodding yes.
Well, if I can say, of course, the thing about tariffs, it's the revenue raising. And that is absolutely the responsibility of Congress and not the responsibility of the White House.
I would like, though, to ask Mr. Hardouvelis about another Trump enemy, let's say, Mr. Powell. What he will do with his interest rates? He didn't want to get them down because he was afraid of inflation. Maybe now he will end up doing what Trump wants in order to stop the lowering of GDP.
I think the Fed is very anxious to make sure it keeps its credibility. So it will behave as it always behaved. It will look at the data and act accordingly. Given the fact that the probability of a recession has gone up, it may, yes, you're right, it may be more, it's maybe more prone towards ease. Because although, you know, the Fed also looks at inflation. And unlike the ECB, the Fed has two aims, inflation and the economy. But given...
and working force, I think she has to...
They may do it, but
unemployment.
I think, but they would like to ease, but they may not behave, they may delay it to show that they're independent to Trump.
Okay.
I think that's my sense.
He has done it already, I think.
So
previous occasions.
But in Europe, on the other hand, the market expects the ECB to ease. I mean, we were expecting the rate to be at 2% at the end of the year, and now everybody expects to be 1.5%.